Before we dive in, hit subscribe so you don't miss new episodes. If you find value, hit like to help us reach more people. Let's get started. Welcome to this edition of The Deep Dive, crafted specifically for you, the learner, who wants to cut through the noise and understand complex topics efficiently. Today, we're diving deep into something that might sound cutting edge, but is quickly becoming a cornerstone of sophisticated financial strategy: crypto loans. We're specifically exploring why hedge funds are increasingly turning to them in 2025. And, not as some fringe experiment, but as a key financial tool.
Exactly. This isn't about taking wild bets. It's really about strategic integration.
Right.
And our insights today, they're coming mainly from an article in privatebanking.one. It's titled Why Crypto Loans Fuel Hedge Fund Strategies in 2025, published just this May.
Okay, so our mission is pretty clear. We want to understand the growing appeal of these instruments for, savvy investors. We'll unpack how they function, the strategic advantages they unlock, look at some concrete examples of their use, and consider the critical factors for those involved. And to guide us through this, we have our expert here ready to synthesize the details and provide that essential context. Okay, let's unpack this then. What exactly is a crypto loan at its most fundamental level?
Right. So, in essence, a crypto loan lets an entity borrow either cryptocurrency or, traditional fiat currency by using digital assets as collateral.
Okay.
Think of it like a traditional securities-based loan where you might pledge stocks or maybe even financing against high-value physical assets like art or something.
So you leverage the value of something you own to get capital without actually selling it.
Precisely.
Right.
But the digital asset space, it introduces some distinct structures and, frankly, unique benefits, too.
And the article highlights two main models that are really gaining traction now. Can you maybe walk us through how these differ?
Certainly. The first one is what's often called traditional crypto-backed loans. You could think of this as, similar to a more conventional term loan.
Okay.
It involves a fixed term, a fixed interest rate, and a fixed amount borrowed. So a borrower, like a hedge fund, would pledge a certain amount of crypto Bitcoin, maybe Ether as collateral, and in return, they get a set sum of fiat currency, like, say, dollars or pounds.
Got it. So let's get into the nuts and bolts a bit. What are the key mechanics, the terms involved in this type of loan?
Okay, so a really critical element is the loan-to-value ratio, or LTV.
LTV.
Right. For instance, if the LTV is, say, 50%, then for every 100 pounds worth of crypto you pledge, the borrower can get a loan of 50 pounds.
Makes sense.
The duration of the loan is also set, typically maybe 2 to 3 years, and interest accrues at a fixed rate over that period. The article suggests, a common range might be 3–5%.
3 to 5%, okay. And repayment.
Usually, the principal amount is repaid right at the end of the loan term, though some deals might include periodic interest payments along the way.
That structure does sound quite familiar, like a lot of traditional financing. What specific needs would this type of loan typically address for, say, a hedge fund?
Well, this model is really well suited for specific, predictable capital needs over a defined period.
Okay, like what?
Think about a private equity co-investment. The fund knows exactly how much capital they need and the investment timeline. Or maybe a real estate acquisition. It kind of mirrors how traditional commercial real estate finance works, leveraging assets.
Right.
It could even be used for significant operational expenses. The real key advantage here is getting that capital without having to liquidate their cryptocurrency holdings.
Yeah, keeping that crypto exposure while still getting the funds they need. Now, the other model mentioned is the crypto credit line. How does that one operate differently?
So the crypto credit line offers quite a bit more flexibility. Instead of a fixed loan amount, it works more like a revolving credit facility. Ah, like a credit card almost?
Sort of, yeah. A maximum borrowing capacity is set based on the value of the crypto collateral held in an account. The borrower can then draw down funds, usually fiat currency as they need them, up to that preset limit.
Okay.
And what's really interesting here is that interest is generally only charged on the amount that's actually been drawn down.
So it's more like having on-demand access to capital, basically.
Precisely. And LTV is still determined, of course. And the facility might be, say, evergreen or have a flexible term. The borrower has the freedom to borrow, repay, and then borrow again.
As long as they stay within limits.
Exactly, provided they stay within the agreed LTD parameters and manage their collateral well enough to avoid what's called a margin call.
Right, margin calls. Can you just quickly define that in this context?
Sure. A margin call happens when the value of the pledged crypto collateral falls below a certain level relative to the outstanding loan. The lender then requires the borrower to either add more collateral or repay part of the loan to bring that LTV back in line. Got it. And what kind of situations would make this flexible model, the credit line, particularly useful?
These credit lines are really ideal for more immediate or tactical liquidity needs.
Tactical.
For example, maybe a fund spots a short-term arbitrage opportunity in the market. They need quick access to capital to jump on it.
Right. Seize the moment.
Exactly. Or they could use it for hedging strategies, managing short-term cash flow ups and downs, or even as a sort of strategic reserve to tap into during market stress.
So speed is a big factor
A
here.
huge factor. The speed you can access funds is a major benefit. It's almost like getting an instant crypto loan in some ways. It is worth noting, though,
Yes.
the interest rates on these credit lines tend to be higher, and they're often variable. The article mentions something like SOFR plus 4-5% typically, SOFR being the secured overnight financing rate, a benchmark rate.
Okay, higher rate for flexibility. So to recap, both models let you leverage crypto for liquidity without selling, but they really cater to different kinds of needs in different time frames.
That's a good way to put it.
Now, the article really hammers home the strategic edge these loans give hedge funds. What makes this more than just, a way to get cash?
Oh, the advantages go well beyond just getting capital. One of the biggest is simply preserving their crypto holdings.
Right.
If a fund is bullish on Bitcoin or ETH or whatever digital asset, they can keep that exposure, keep that potential upside appreciation while still getting the liquidity they need right now.
Yeah, you avoid potentially missing out on huge gains if the market rips higher after you sold.
Exactly. Imagine selling right before a major bull run.
Ouch. Okay, what's another key strategic advantage?
Another really crucial aspect often is the non-recourse nature of these loans.
Non-recourse. What does that mean practically?
It typically means the loan is secured only by the pledged crypto collateral. So if the collateral's value tanks and maybe a margin call isn't met for some reason, the lender's recourse is generally limited just to liquidating that pledged crypto.
So they can't go after the fund's other assets.
Generally, no. They can't pursue the fund's other investments or assets to cover any shortfall. This non-recourse feature fundamentally changes the risk equation compared to traditional loans where, lots of other assets might be on the hook.
I see. That definitely limits the downside risk for the fund.
Hugely valuable, especially in a volatile market like crypto. It helps prevent problems in one area from spreading, contagion to other parts of their portfolio.
Okay, that makes a lot of sense. The article also mentioned faster response to market events, especially with credit lines. Why is that speed so critical here?
Well, crypto markets move incredibly fast, right? Opportunities can appear and disappear in like minutes or hours. Having a pre-approved crypto credit line means a fund can get capital almost instantly. That speed is absolutely paramount for strategies like arbitrage trading.
Their timing is everything.
Exactly, exploiting tiny price differences quickly. Or for rapidly deploying capital to hedge against a sudden market drop. It really is about using your crypto to get immediate access to funds when, time is absolutely critical.
And how do these loans help when markets get really choppy during those downturns? Crypto is famous for volatility.
Yeah, market downturns are tough. They can be a double whammy. Your asset values are falling. And at the same time, you might face increased needs for cash, maybe from investor redemptions or margin calls on other positions.
Classic liquidity squeeze.
Right. And in those situations, a crypto loan, whether it's a fixed term one or drawing from a credit line, can be a vital alternative to being forced to sell assets.
Selling low, which nobody wants to do.
Precisely. It lets the fund get the fiat or even crypto liquidity they need to meet obligations, stabilize things, maybe even strategically buy assets that look cheap now, all without having to dump their core digital assets at fire sale prices.
So it protects capital and positions them better for recovery.
Exactly. It preserves capital and lets them position for a potential rebound. That hypothetical March 2024 sell-off scenario the article mentioned, that's a really good illustration of how this safety net works in practice.
Okay, so recapping those advantages. They empower funds to rebalance, manage risk better by kind of ring-fencing it, keep their desired asset mix, and have capital ready. Let's make this even more concrete. Can you give us some real-world type examples of how these loans are actually being used?
Yeah, the article had some good ones. Let's take a hedge fund holding a lot of Bitcoin. They see a great opportunity, maybe co-investing 10 million in a tech company, but they need the cash in, say, 30 days.
Okay.
Instead of selling their Bitcoin, which, remember, could trigger taxes and lose potential upside, they pledge some Bitcoin as collateral for a fixed-term loan, maybe in USD or GBP.
Right.
They get the 10 million pound, make the investment. And then they plan to repay the loan down the line, maybe with future fund inflows or just by strategically managing their crypto over time. It really shows using your crypto to get a loan for diversification or expansion.
That clearly shows how crypto can unlock opportunities in, well, traditional markets. What about uses within the crypto space itself?
Okay. For tactical hedging or arbitrage within the digital asset world, that crypto credit line is incredibly useful.
The flexible one.
Yeah. Imagine a quant trading fund. They spot a short-term arbitrage needing, say, 5 million pounds in stablecoins. They already hold plenty of ETH and maybe USDC. So they quickly tap their pre-approved crypto credit line, draw down the stable coins they need against their ETH-USDC collateral. They execute the trade, hopefully make a profit, repay the drawn amount quickly, maybe even the same day or within a few days.
And only pay interest for that very short period.
Exactly. Minimal interest cost. It just highlights the sheer agility you get from having that flexible borrowing facility ready to go.
Okay, and the volatility navigation example you mentioned earlier.
Right. The scenario of a sharp market correction, like that hypothetical March 2024 sell-off, that really drives home the vital safety net aspect.
Oh, so.
If a fund faces margin calls elsewhere or expects investors might ask for their money back during a panic instead of being forced sellers in a falling market.
Which just makes the fall worse.
Right. Instead, they draw on their crypto credit line.
Yeah.
That gives them the fiat or maybe stable coins, whatever liquidity they need to meet those obligations, stabilize their portfolio, or even, as I said, maybe buy some assets that look really beaten down. And crucially, they do it without selling their main crypto collateral.
Got it.
Yeah.
These examples really bring those strategic benefits to life. Now, the article suggests this is all gaining popularity now. Why?
Right.
What's maturing in the landscape to drive this adoption?
Yeah, it seems like several key things are coming together. For one, we're seeing more sophisticated lenders emerging, platforms and institutions with really robust systems for underwriting, for managing risk, handling LTVs, margin calls, all specifically designed for crypto's volatility.
So the infrastructure is getting better.
Definitely. And alongside that, in many important places, there's better regulatory clarity around digital asset lending.
Yeah.
That boosts confidence, that loan agreements are solid, collateral is secure.
Makes sense. Regulation helps adoption.
It does. Then there's the crypto markets themselves just maturing. Generally, better liquidity, more market depth means less risk for lenders when they might need to liquidate collateral, and that can translate into better rates, tighter spreads for borrowers.
Okay.
And finally, there's just growing demand for different kinds of lending. Traditional finance players are looking for yield, and carefully structured crypto-backed loans look increasingly attractive to them.
So sophisticated lenders, clearer rules, better markets, and more demand all coming together.
Exactly. That whole combination is making these loans more accessible, more reliable, and just strategically much more viable for institutional borrowers now.
Okay, so for those sophisticated borrowers, the hedge funds or others who are thinking about using these crypto loans, what are the absolute crucial things they need to keep in mind?
Right. There are definitely some critical points. First and foremost, you can't ignore the volatility risk of the collateral itself. Crypto prices can swing wildly, very quickly. That can trigger margin calls. So it's really smart to use a conservative LTV. Maybe don't borrow the absolute maximum possible.
Leave some buffer.
Yeah, leave a buffer. Monitor the market closely. And crucially, have a plan ready. Know if you'll add more collateral or repay part of the loan quickly if needed to avoid getting liquidated at a bad price.
Okay, manage the volatility risk. What else?
The type of loan is key too. Does a fixed-term loan match your need, or is the flexibility of a credit line better? Choosing the structure that really aligns with your strategy is essential.
Makes sense. Choose the right tool for the job.
Precisely. Then there's lender due diligence. This is huge. Funds need to really vet potential lenders, check their financial health, the compliance record, security practices, their actual experience in crypto lending, and make sure their fees are totally transparent.
Don't just go with anyone.
Absolutely not. And related to that is legal clarity. Given how new some of this is and how regulations differ, you need legal experts. Make sure that the loan agreements, the collateral claims, are absolutely watertight across all the relevant jurisdictions.
Dot the I's, cross the E's legally.
You have to. And finally, tax implications. Generally, just borrowing isn't a taxable event in most places. But what you do with the borrowed funds or what happens if collateral is liquidated, those things can definitely have tax consequences that vary. So getting expert tax advice is really non-negotiable.
Okay, so volatility, loan type, lender vetting, legal soundness, and tax advice. Lots to consider. It sounds like while these loans offer really powerful advantages, you need careful planning, thorough diligence, and a clear understanding of the risks to actually use them effectively.
That sums it up perfectly. Careful consideration and working with experienced, reputable counterparties are absolutely key to mitigating the risks and unlocking the real power here.
So to kind of wrap up our deep dive here, it seems pretty clear that crypto-backed loans have really evolved. They're not just some niche product anymore. They're becoming sophisticated, almost essential liquidity management tools for institutional players like hedge funds. They let you get capital without selling your digital assets, which helps with diversification, allows for those quick tactical moves, and gives you a cushion against market swings. For anyone operating in this space, really understanding the loan structures, carefully managing that LTV, and doing thorough lender due diligence, those seem like the critical success factors.
Absolutely. And I'd add, these loans fundamentally help protect against forced selling at bad times while enabling smarter capital deployment. As digital assets get woven more tightly into traditional finance, I think these tools will become just a core part of institutional strategy.
Yeah, it really makes you think, doesn't it? This increasing integration of digital and traditional finance. How will that continue to reshape investment strategies, market dynamics, everything really going forward? Something definitely worth pondering.
Indeed. It's a fascinating space to watch.
Thanks for listening. If this helped or made you think, hit like. It shows this content matters. And tap subscribe if you haven't yet. See you next time.